The 1929 stock market crash wiped out fortunes overnight and triggered the Great Depression. Here's the scary part. The same mistakes people made back then are being repeated today. So let's break this down. What actually happened in 1929, why it mattered, and most importantly, the lessons you can use right now to protect your money from history repeating itself. Back then, the market was booming. Everyday people were piling into stocks, often with money they didn't have. Brokers let you buy stocks with only 10% down, what's called buying on margin. That meant if you had $1,000, you could control $10,000 worth of stock. Sounds great, until prices dropped. Then you owed more than you owned. The lesson today? Leverage works both ways. Options trading, margin accounts, crypto with borrowed money. It feels like easy wins in the good times, but the second markets turn, debt magnifies the crash. Don't gamble with money you can't afford to lose. In the late 1920s, the mood was pure optimism. Headlines claimed the economy had entered a permanent high plateau. People believed growth was unstoppable. You've probably heard the same words in modern bubbles. Dot-com stocks in the 2000s, housing in 2008, crypto in 2021. The lesson? When people say, "Don't worry, it can only go up," that's your red flag. No market rises forever. The smartest investors assume cycles, not miracles. Another problem? Most families had no emergency fund. When jobs disappeared, savings vanished with them. Banks weren't insured, so deposits were wiped out if a bank failed. Millions lost everything. The lesson for us is clear. Keep a financial safety net. 3 to 6 months of expenses in cash isn't paranoia, it's protection. And unlike 1929, today we do have FDIC insurance, but that doesn't replace your own cushion. In 1929, when stocks started falling, panic spread. People sold in waves, driving prices even lower. No one wanted to be the last one holding the bag. Fear fed on fear. Fast forward to today, social media accelerates this effect. A viral tweet can spark panic selling in minutes. The fix? Set your strategy in advance. When to buy, when to sell, and stick to it. Don't let the crowd dictate your moves. So here's what you can take away. Avoid margin gambling. Question: this time is different. Keep a cash buffer and never blindly follow the herd. If you do those 4 things, you're already ahead of 90% of people when the next downturn comes. History doesn't repeat word for word, but it rhymes. The 1929 crash showed how overconfidence, leverage, and panic can destroy wealth. Learning those lessons now means you don't have to live them later, because the smartest investors aren't the ones chasing hype. They're the ones who remember what happens when the music stops.